Good morning, good afternoon, depending on where you are. My name is Jay Martin. I am the CEO of Cambridge House. And what we're doing on the channel today is hosting a micro event, which is really a follow-up event to a larger production we had on the channel here about 2 weeks ago. The VRIC, the Vancouver Resource Investment Conference, was a combination of about 70 interviews, one-on-one conversations between myself and a variety of industry experts and company CEOs from the commodity sector, with the intention of developing my investment strategy in the commodity space in 2021. Now, you can't help but host so many conversations in such a compressed amount of time as we did then, without picking up on where there is consensus in the market and where there is still room for debate. Now, without question, across all the conversations I hosted in the last month, we've reached absolute consensus from the personalities that I talked to that we are in some version of the logical conclusion of our financial system as we've known it for my entire life. Where there's room for debate, well, how that will unfold, when that will unfold, and most importantly, what will happen next. Now, you never really get to the concrete answers of those last 3 questions, but you can try. And what we're gonna do now is gather as many perspectives as possible on how that may roll out so that we can then apply those ideas to our portfolio in the way they make the most sense. So today, that is the focus. And we're gonna start with a debate. I'm bringing back 3 personalities from the VRIC. Raoul, the co-founder of Real Vision Television and the author of Global Macro Investor, Peter Schiff, CEO of EuroPacific Capital, and Brent Johnson, founder of Santiago Capital. And we're gonna be debating the top asset class to hold in 2021. Raoul will be defending Bitcoin, Peter Schiff, gold, and Brent Johnson, no surprise, US dollars. I really hope you enjoy this debate. Following that up, I'm joined by Danielle DiMartino Booth, the CEO of Quill Intelligence and the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. She's always a rock star to have on the show, and I'm really excited to share this conversation with you. She's absolutely brilliant. And then I'll be joined by Grant Williams, the author of Things That Make You Go newsletter, which is one of the most widely read financial publications in the world. He's also the host of the Grant Williams podcast, again, one of the top ranked podcasts in the financial world. But look, this interview with Grant was maybe one of the top 5 interviews I've ever done. I really, really enjoyed this conversation. I hope you enjoy it. I'm excited to share this with you today. I will also be joined by the executive team at my top gold pick for 2021. And I'm excited to share that with you too. Enjoy. What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome. Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Raoul, the founder and CEO of Global Macro Investor and co-founder of Real Vision TV, Peter Schiff, CEO of EuroPacific Capital, and Brent Johnson, CEO of Santiago Capital. How are you all doing?
Fantastic.
Doing good.
Okay, well, thanks so much for coming together and letting us frame this conversation and have this panel. As you guys know, we just wrapped up the VRIC, which was a big summit that we hosted on our YouTube channel. It consisted of about 75 one-on-one interviews, 50 of which I hosted myself, and it was a total blast. And you can't have that many conversations with macro thought leaders like yourself and money managers and everybody in between without leading with a bunch of new information and usually a bunch of new questions as well. And I definitely left with both. When I have those conversations, I can't help but notice, and I try to pick up on where I see consensus, where everybody I'm talking to seems to agree, and then where there's still room for debate. And it didn't matter who I was speaking to over the last couple of weeks as we put this feature together, or just in the regular programming on this channel. Whether it was a small cap money manager or all the way up into, we talked to the 22nd Prime Minister of Canada last week, Stephen Harper, there's consensus. And I believe from the 3 of you as well, that we're now in what you may refer to as like the final innings, right? The final stages of our financial system as we've known it for my lifetime. Now, I don't want to frame this as some sort of like sensational doom narrative. All of you guys have been on my show a few times. I think, that's not my style. I try to come at this with a pragmatic mindset. At the end of the day, like, I'm a small business owner. I'm an investor. I manage my own money. I have 3 kids and a mortgage. I'm just looking for the best path forward. And I know there's never right answers or right predictions. All we can do is gather as many perspectives as possible and then make our best decision with the knowledge that we have. And so, what I want to talk about today is that consensus that, we're in the final stages of this financial system. And the reason that we should maybe consider that seriously, and I want to steal a Dalio quote. It's hard for us to wrap our mind around things like that, like a financial system that's existed for my entire life actually collapsing or changing at a systemic level that's sort of hard to recognize because we've never experienced that. If you grew up in Canada, the US, or most parts of Europe, you haven't been through that before, right? And Dalio has a great quote where he says, "Through my career, I noticed several things that happened that had never happened before in my lifetime." And when you study history, you realize they've actually happened several times before my lifetime, right? And so maybe that's a good place to start. My role in this conversation is really a student. I'm going to moderate and try to stay out of the way because I want to hear what all 3 of you have to say. And Raoul, maybe I'll pass the puck to you to begin. First of all, just based on what I've just said, that I perceive consensus across almost everybody that comes on this show that we're now, and it's not hype anymore. There's quite logical arguments to say that we're at the logical conclusion of our financial system, whether it's, the fourth turning as you reference, or the end of a 50-year pure fiat currency experiment, whatever. But we're there now. The music's slowing down, and there's probably not enough chairs for everybody. Would you agree with that? And if so, could you maybe touch on your rationale?
I think we need to be careful. I think on a secular basis, it's in decline. But those of us who lived through 2008 and 2012 have realized that it's not over necessarily. There's more experiments, more things that can be done. That's all part of the over process. But I don't think there's a finite stop here. The next iteration we're already hearing is the central bank digital currencies that try and move away from the dollar. We're starting to see talks of a debt jubilee, or whether they should issue a perpetual bond like the consuls in the UK were after the war. So there's a number of things they're still going to try to keep this alive. The question is how long does that ending process take, and what form does it take? I think all 3 of us would probably agree that somewhere along that process, there's the death of fiat currency. When, how, in what form does it take? And I think, for me, it's not clear. For me, all I do know is there's a fight to come.
Okay. I love it. Peter, what are your thoughts on what Raoul just shared?
Well, I agree that, a lot of people, myself included, underestimate the ability of central banks and governments to delay the day of reckoning and kick the can down the road. But, I think if you really look objectively at where we are now and the enormity of the problem relative to where we were, say, back in 2008, just how much more debt that the U.S. has taken on. And remember, the way that America was able to kind of con the world, it was in convincing everybody that 0% interest rates was a temporary emergency measure, and that rates would normalize, that quantitative easing was just temporary, and that the Fed was going to shrink its balance sheet back down to pre-crisis levels. And then, global central banks, the ECB actually brought interest rates to negative to make the Fed's rates of zero actually looked high by comparison. And there was this built-in expectation that the Fed was going to start raising rates long before the rest of the world, and the Fed was going to be tightening while everybody else was easing. And of course, back then in 2010, 2011, you had all these foreign central banks that were big buyers of U.S. treasuries, all the emerging markets. China was buying dollars in treasuries. I don't think they're doing that anymore. In fact, I think they want to get rid of dollars in U.S. treasuries. Even the government's own, so-called trust funds, like the Social Security Trust Fund, which was a big buyer of U.S. treasuries, is now a major seller of U.S. treasuries, and that's going to continue. So I think if you look at the enormity of the money that we need to print, the enormity of the deficits. I mean, the government is now spending $8 trillion a year and collecting $3.5 trillion in taxes. I mean, that is money printing on an unprecedented scale. It dwarfs anything we did after the '08 financial crisis. So to think that we can get away with it again, that we can con the world another time and continue to kick this can down the road, that's not a bet that I want to make. I'd rather bet that, we've reached the end of the line and the dollar's decline is going to maybe be terminal this time. I think it's going to be much worse than the decline we had from 2001 up to 2008 time period. I think it's going to be a lot worse. And I think it's going to end in a crisis. And what's on the other side of that crisis, I don't know. But I think there is a big day of reckoning for the U.S. And I think ultimately the world is going to be a much better place when the dollar is no longer the reserve currency and the world no longer has to subsidize, massive consumption in the United States, and it doesn't have to finance our debts, our trade deficits, our budget deficits. So I think there's going to be a lot of opportunity, a lot of growth outside the United States, and I think I'm pretty well positioned to capitalize on that.
Okay, thanks, Peter. Now, Brent, over to you.
Yeah, so I think I'd build a little bit on both what Raoul and what Peter said is, I wouldn't disagree with your characterization that we're moving towards the end game, but I would just say that, we're moving towards it. And despite the fact we're moving towards it, I don't think we're there yet. And I actually think it'll take a little bit longer to play out than most people I speak to. Now, that doesn't mean that it's not going to play out. I just think that their ability to keep the plates spinning is high. And so I'm not expecting this to happen tomorrow. And I think you should be ready for it to happen tomorrow, but I don't think you should necessarily bet that it's going to happen tomorrow. And the other thing I would say, kind of building on what Peter said, is that, I think he characterized it as the U.S. conning the rest of the world. And truth be told, I wouldn't really disagree with that characterization. I would just add to it that, Europe has conned the rest of the world. Japan has conned the rest of the world. China has conned the rest of the world. Australia, Canada, Brazil. Everybody is doing the same thing. If this was a situation that was in any way unique to the United States, then I would perhaps, probably change my view. But it's not. It's really not. And every time the dollar is spoken of and its inevitable demise is spoken of, it's always a focus on the supply side of the argument. What few people ever seem to take into account is the other side of the argument, which is demand. And to get a price, you have to find the equilibrium between price or between demand and supply. And sure, we are, quote unquote, printing money on a level never seen before. But so is Europe, so is Japan, so is everybody else. It is not a unique situation, and we have a number of quote unquote advantages or demand drivers that other currencies do not. And I would even go so far as to say the more we print, the higher the dollar is going to go, because it will force everybody else to print as well. And I don't really have, I can go through some of the reasons why that is, but I ultimately think this is going to take longer to play out. And I think the signs that show that the monetary system is coming to an end will be the dollar rising rather than it falling.
And Jay, there's another point to this also is we're so used to looking at things in dollar terms. Take away the dollar. For example, I use a basket of 27 global currencies, excluding the dollar versus gold. When you look at it that way, gold becomes the global currency, and you can see all of these currencies devaluing versus gold. And because, as Brent says, there's this rotation of printing money and abusing fiat rights. But when you look at it in gold terms like that, simply, it does protect your wealth. So if you're a global citizen or you have earning power around the world, it kind of works. So I think sometimes we should reframe this away from the US versus them and think of it in terms of what are we doing to the entire monetary system globally? And that, I think, is very different and unique.
Yeah, I mean, there's no question that all these central banks are debasing their currencies. And so all currencies are losing value relative to real money, which would be gold, and they're going to lose value at different rates. But I disagree that all the countries are in the same boat, because the only reason the United States can run enormous trade deficits is if other countries are running enormous surpluses. So somebody has to be producing the goods that Americans are borrowing to consume. And also, if the United States is a big borrower, then the rest of the world is a lender. So the United States is the world's biggest debtor nation, but the other nations of the world collectively have loaned us all that money. So there are creditor nations and there are debtor nations. So I think that the United States is in a particularly vulnerable position because we have built an entire economy that's built on the false foundation that we can print money indefinitely to buy the things that we can't produce. And we can borrow indefinitely without saving. And that the world is going to loan us money in an ever increasing quantity when we can't even pay back what we've already borrowed, let alone the money that they're intending to lend us. So I just think this idea that this can go on forever is wrong. And that, it's already got on for longer than most people who understand it could have possibly expected. So can it continue to, defy those odds and continue to go on? Yes, it could, but I wouldn't want to bet on it. I'd rather bet against it. And to me, if everything collapses tomorrow, I'm in great shape. If it takes another 5 years, I'm still in great shape. I'm not buying investments that have a time limit. I'm not, with options with an expiration. I'm just adopting an investment strategy that takes into account the end game. So I don't have to worry if I'm too early or too late. I'm just positioned for how I know things are going to end up. And however long it takes to get there, I'm there in the final analysis.
And so just to give them,
go ahead. No, just one point I'd make just to follow on what Peter said there. He said, I wouldn't bet on it lasting longer. I wouldn't bet on the game continuing to go. And listen, I completely get that view. And, I've expressed my opinions pretty strongly the last couple of years, not because I want everybody to go out and sell their gold and not prepare for that eventuality. But what I would say is that the world right now is positioned for it to end tomorrow. The world is positioned for the dollar to go to zero. The world is positioned for this global reflation because every central bank is printing money. Hold on, Peter.
I don't think so.
Peter, okay. I can just show you the positioning. Sentiment in the dollar has never been higher. Sentiment in the euro sentiment in the dollar has never been lower. Sentiment in other currencies has never been higher. The positioning on copper, steel, lumber has never been higher. The short position, the speculative long position on oil is near its all-time high. The consensus trade, no matter who you talk to, is to go long commodities, emerging markets, and short the dollar. So listen, and maybe that would be right. But that is the consensus trade. No. To think that you're buying foreign currencies, commodities, and emerging markets because you're some kind of contrarian, it's just not accurate. Now, it doesn't mean it's wrong, but it's just not accurate to think that that's a contrarian trade.
Now, I think that it is a minority. Most people are positioned long U.S. equities. They're not positioned for that type of outcome. And I think if you were to question the people who now think the dollar is going to go down, I don't know that they think it's going to go down nearly as much as it is. So you could say that maybe there are some people that think the dollar is going to go down, but there's not that many people who think it's going to collapse. So I think the consensus still has it wrong. They think there'll be an orderly decline in the dollar, and I disagree. I think it will be very disorderly, and it won't just be a decline. It's going to be a crash.
Also, just to add one point about the dollar. When we talk about flows, in terms of deficits, etc. The one thing everybody forgets that the US has, unlike any other nation, is that it's 24% of global GDP, but it's 88% of every single trade transaction on earth. So everybody needs a dollar. So unless that mechanism changes, which the IMF and the BIS are talking about, is trying to change that mechanism, it's really hard for the dollar to get into a structural decline until people start moving. Now, we're seeing China's moving towards it. I mean, everyone's trying to move towards it. So I think we all agree that at some point the dollar declines significantly. But it's difficult when it's 88% of world trade.
Well, but the dollar is in a long-term secular decline. It's been declining since the early 70s.
Hold on. So, Brent, you touched on one thing that I wanted to dive into a little bit. you said sentiment in foreign currencies has never been higher, and you touched on the emerging markets trade that you see consensus driving towards, and you disagree with that. And it struck me because, one of the things I want to pull out of this conversation is for myself and my audience is, where's the life raft, right? Where is the safe harbor as things begin to unfold here? And I've heard Peter talk about the emerging markets trade. It actually came up a lot in the conversations we had in the last couple of weeks. And Raoul, it came up with you, although your timing was a bit different. You were looking at the emerging markets trade like 12 months down the road, right? And Brent, you don't see that yet. So I wanted to dive into that timing a little bit. So you don't agree right now, Brent, that emerging markets are a safe place for capital. Could you elaborate on that a little bit? And then Raoul, I'd like to pass it to you to touch on why you look at the 12-month timeframe.
Sure. So, people have heard me say that, being long the dollar is one of the biggest trades, if not the biggest trade in history. And listen, I believe that. And I wouldn't be out here telling people that if I didn't believe that, and if I didn't have my own personal money exposed to that. But that's really just a big setup for the next biggest trade. And the really long-lasting trade, which I think is the trade that Raoul and Peter probably would agree is coming. Eventually, I want to get out of dollars and get out of US dollar assets and go buy emerging markets, buy commodities, buy foreign currencies. Because I think once the dollar has had its rise and, the system gets quote unquote reset, whether that's orderly or disorderly, then I think the play is to kind of sit back and ride the emerging markets wave for, 5, 10, 15 years. I just think the system has to reset before that comes. I think the debt has to get reset. It's all, at the end of the day, my thesis is all about the debt. And debt, until there is a substitute that everybody agrees on, debt is a demand for a currency. And most of the global debt out there is in dollars. And people don't like me saying this either, but you've seen these charts of the global reserve currencies. They last 100 years and then it gets passed on and it gets passed on. Global reserve currencies are never relinquished, are never given over. They're always taken over by the next person. And until there's somebody that can take the U.S. on as a global hegemon and enforce the new global reserve currency, the dollar's it. Now, you might not like it. You might not want dollars. You might not like using dollars. But as it is right now, you need to use dollars. And I just think that that's going to play out much differently because of those dynamics.
Yeah, well, remember, I think it's about the debt, too. I just think the debt's going to be inflated away. I mean, that's the problem with the debt. We can't repay it, so we have to inflate. We have to pay down the debt by debasing the currency. I mean, that's what's happened to every major debtor, is its currency has gone down. I mean, the United States would be the exception to that if somehow we can have all this debt and end up with a stronger currency, not a weaker currency as a result. I mean, that's the way the debt goes away. It's because the value of the dollar goes away. And therefore, the creditors don't get repaid. Instead of defaulting, honestly, they get repaid in money that doesn't have much value. That's where I think we're headed. And I think what you have to ask yourself is, at what point, if I'm right, because if you're right, I'm prepared to hold dollars through any rally. I've done it before. I'll do it again. I'll hold my foreign stocks. I collect my dividends. I think I'm fine. And if we both agree that in the final analysis, the dollar is going to crash, then I'm fine. But what do you do if I'm right and the dollar has already seen its highs and we just keep going down and then we crash? And so when do you change your mind and say, you know what, I got to get rid of these dollars before there's nothing left, and then buy into real assets, commodities, emerging markets, which, by the way, even if there's a lot of people buying them, they're still cheap. I mean, if you look objectively at the PEs of the emerging markets relative to the US, I mean, they're a bargain. So even if it's a crowded trade, it's just getting started. But the point is, what do you need to see before you say, I think Peter is right and I better do something to change my strategy?
Well, again, because we both see the ultimate end game the same, I already have positions and clients have positions that will benefit and do well if you're right. I've never told anybody to sell everything they own and go 100% into the dollar. What I've said is to build a diversified basket of assets and place a small portion of your overall portfolio to the dollar spiking, because if I'm right, the asymmetry of those trades is such that it can help protect against everything else and potentially have some life-changing alpha accompanying with it. If the dollar, if you look at diversified portfolios that we manage, we own equities, we own gold, we have some cash, we have short-term fixed income. All my clients own real estate, real assets. There's a little bit of Bitcoin in there. I actually like Bitcoin. I have a lot of problems with Bitcoin, but I actually see the great potential that it has. So if the dollar goes to zero tomorrow or goes down, continues to go down, we may not make as much money as anybody else who's leveraged to that play, but we'll be okay. But if we go through a spiking dollar event, I'm not sure people that are 50, 60, 70 years old living on their nest egg are going to have the time frame to survive that. Now, maybe they will. I hope they do. Part of the reason that I've pounded the table as hard as I have on the dollar is not to get people to go sell their gold, not to get people to go liquidate their portfolios. It's to be aware of what can happen to the markets when the dollar does spike. I mean, let's remember a year ago on March 1st, the dollar was at 97. 9 days later, it was at 94. And everybody was saying, here it goes, the dollar's going to crash. And 10 days later, it was at 103 and the world was on its knees. And every asset in the world was getting sold for dollars. That's what I want people to be aware of. That's what I want people to be prepared for, because it can come out of the blue. And when it happens, it can be extremely, extremely damaging.
Yeah,
Now,
remember,
Raoul,
the spike wasn't that big and it didn't last very long.
Raoul, I'd love to hear your thoughts on this.
My view is I err towards a stronger dollar. I think it'll be the surprise trade of this year for many of the reasons that Brent talked about. I also think that the kind of repayments of debts, because everything's on hold, again, creates dollar demand that Brent talked about, the positioning, all of that stuff. I've got an alternative thing that is bugging me. I'm starting to get concerned that the dollar ends up becoming the yen. Now, what that means is the yen has been pegged at 105 for 30 years. It goes up and down a bit. This is a scenario that nobody takes into account. This is the central banks, the IMF, everybody trying to stop the system falling apart. Because if Brent's right and it goes to 130, the system's gone. If Peter's right and it goes to 70, the system's gone, right? So if you think in terms of central banks saving the world, the one outcome that nobody really thinks is a sideways dollar for an extended period of time. Okay. So let's call it pinned between a 110.85 range in DXY. Now, okay, in that world, how does that do? I think Peter does well. I think his gold bet plays off because stability within a system based around printing of money and other stuff, he's going to do well. I think Brent will do well because I think the dollar goes higher first. I think Brent and I both share the view, and Peter does, that emerging markets will do well. If the worst thing for emerging markets is dollar volatility, it's a crusher. Dollar going up and volatile is the worst of all. But a sideways dollar, which we saw back in kind of the mid-2000s, was extraordinarily powerful because nobody had to worry about borrowing in cheaper currencies. Now, everybody else got negative rates, so you can borrow in any currency you choose. And so that tends to be very powerful for emerging markets. So I kind of think Peter's scenario of a weaker dollar, good for emerging markets. Sideways dollar, good for emerging markets. Brent's idea, which I also agree with, a strong dollar, bad for emerging markets, which is why I have a lag between my bullishness overall for emerging markets versus my structural bias for emerging markets, which is a much longer big picture view. So I'm somewhere in the middle of all of this. My big concern that nobody talks about is if the dollar trades sideways.
Right. Okay. And then so does that support why you've kind of exited and you're sitting so heavy in cryptos right now? Is that the
crypto trade is, for me, it's the supercharged trade of what Peter's doing. There's no, I love gold. I've held physical gold for a long time. I'm not running other people's money. What I'm doing is trying to maximize my own profit. Yeah. And in this situation, I see both the narrative change towards the digital gold. Again, doesn't matter if anybody believes that or not. That's the narrative now. So it gives it an anchoring bias. And then the Metcalfe's law adoption that you're seeing of Bitcoin. So that means it should rise significantly over this period of time. And it's independent of the dollar. It's independent of all of these things. It's in its own cycle right now. It's pretty uncorrelated over anything longer than 3 months. In fact, I've just commissioned a study that we're doing for Real Vision, which will get released publicly in due course. And it's basically the least correlated asset of all over any time period longer than 3 months. So
now, if that wasn't an asset that was so recently created and an option for you, because I feel like that's where you're going to ride out the storm until you know more about what will happen with the emerging markets trade. Is that somewhat correct?
Well, maybe at some point I just flip my Bitcoin back into gold.
Right. Yeah. Okay. That's what I was wondering.
All I'm looking for is relative outperformance at this point. All of these assets are good. I like the dollar. I like Bitcoin. I like gold. We juggle amongst those. I want to be positioned long term to sit in emerging markets for 10 years. It's a miserable world to want to sit into gold because we have to look at the negative side. And sometimes it's nice to be optimistic, and emerging markets are optimistic. So you can get people behind that. You can get behind it yourself and have a narrative that you can believe in. And that's nice as an investor to not talk about doom and gloom all the time.
Okay. Now, Peter, I saw you nodding towards the end there. Love you to contribute.
Yeah, well, just, the comments on Bitcoin and whether or not it's correlated or not. I mean, it's hard to say. I think there's some correlation with other risk assets. I mean, the last year has been, a spectacular year for risk assets. I mean, they've gone way up. I mean, Bitcoin among them. I didn't really expect Bitcoin to have the big year that it did. I mean, I think I was bearish, coming into the year. And, obviously Bitcoin went up a lot, but fortunately there were a lot of other stocks that are risky that went up even more than Bitcoin. And I was fortunate enough to have owned some of those stocks. But, a lot of people talk about Bitcoin as if it's some type of alternative to gold. And I don't look at it, because it has nothing in common with gold. It's nothing like gold. Gold is a safe haven store of value. None of those properties are in Bitcoin. I mean, Bitcoin is a very, very speculative digital token. I mean, maybe the price will keep going up, or maybe it's going to crash. I don't look at gold that way. I look at gold as a way to store wealth and preserve value. I don't think anybody even thinks about Bitcoin in that respect. Nobody who's buying Bitcoin is trying to store anything. They think they're going to get rich. They expect it to moon. So I think it's a very risky asset. And personally, I think if you're going to buy risky assets, I think there's much better assets to buy that have a lot more substance behind them, that have less downside risk and actually more upside potential than just gambling on Bitcoin. Everybody is so confident that Bitcoin is going to have another great year because it had a big year last year. Well, I remember how confident everybody was at the end of 2017 because Bitcoin ran up to 20,000 and they were predicting 50, 100,000, 250,000, all these crazy pie in the sky forecasts in January of 2018, and Bitcoin dropped 70%. So, I think it can easily do the same thing. And I think that what eventually is going to happen with Bitcoin is it's going to fall 70, 80%. And then not recover, but just fall another 70, 80% or another. I think there's no real bottom in Bitcoin once the speculative buyers become sellers. Okay.
Now, where I want to pull this back to is, everybody's opening statements had some similarities in the sense that Raoul touched on sort of unclear, where we're at in this cycle. Peter, don't underestimate the power of central banks to keep kicking this can down the road. And similar, Brent, you echoed that with their ability to keep the plates spinning. So I wanted to see if any of you could identify any trigger points that we could look out for in the next, call it near term, 18 months. And I don't think stimulus would be one because it's now just an expectation. But, Raoul, you referenced the issuance of central bank digital currencies or some kind of a debt jubilee. Are there any events that might be off the radar of investors that could come to the forefront really quick here in the next 18 months that could change this conversation and these arguments?
I don't think so. I don't think the 18-month time horizon is the right time horizon for a fix. I think it's just going to be governments and central banks doing what they can with the current situation.
Okay.
I don't think there'll be enough forward planning. Central bank digital currencies, how that plays out. Even the ECB have said it's some time away. The only thing I would just say is let's see how China and the Asia region deals with the Chinese central bank digital currency and whether they start adopting it for trading purposes or not. I'm not entirely clear that without the IMF and everybody else getting involved in various projects, that it will be. That's the only thing at the tipping point. I don't see a dollar collapse in this environment. And I don't see a dramatic shift to the end game. I think it's more likely that it's a little more complicated path than we imagine. That maybe the first half of the year is worse than people imagine. And then after that, maybe we get the reflation. And I think, again, I share Brent's view that the dollar's probably stronger than not. So the 18-month time horizon for me is not one to fear.
Okay. Brent, any thoughts? And extend that horizon if you...
Well, I think the way I'd say it, and I'm going to kind of touch on something that Peter said a minute ago, because he's actually right on this point, and I think it's important to point it out, is I made the comment that on, March 9th, the dollar was at 94, and 10 days later it was at 103, and the world was at its knees. And he said, but it didn't last that long. The Fed got it under control, and they've printed, and and listen, he's completely right. They have. And I think that's the point I want to make, is that the thesis, or the consensus right now is that the central banks are in control. They got it under control, and they can do it again. All they have to do is hit Control P. And I think that is wrong. I don't think the central banks, even though I think their ability to keep the plates spinning on an overall basis is longer than a lot of people think it is, I do not think that they are fully in control. And I think there will be periods of time where they completely lose control. And I think whichever central bank loses control first, that's where the problem is going to pop up, and that can have contagion effects.
Now, what's that going to look like, Brent?
Well, maybe it looks like a banking system issue in Italy because the ECB loses control. They're already trying to.
Well, one of the other ones that you and I have talked about, Brent, is Japan, right? Let's say
exactly.
that piece of COVID increased. They locked down Japan. The Bank of Japan is now forced to do even more stimulus. It currently owns 70% of all of its bonds. Does it go to 100%? Because that is the end game. If Japan buys all of its bonds, it's the end game. And then, we've got the rule book. All three of us understand that. That's all systems go, because the Japanese have led the way for everybody.
Yeah. And I don't know for sure where it's going to happen. I just know that the table is set that if the central banks lose control, it ain't going to be pretty. And when the central bank, the dollar going lower is the central banks in control, because the world knows the dollar going higher is a wrecking ball. So when central banks start to lose control, it's not going to be the dollar going lower. The dollar going higher is when the central banks lose control. That's the way I see it. And I know a lot of people disagree with me, but that's my case.
Yeah, and I'm one of those people, because I agree with you that the central banks are going to eventually lose control. But I think what they lose control of is stabilizing the dollar, preventing the dollar from falling. If you look at what all these sovereigns have been doing over the years in accumulating U.S. dollars and buying up U.S. treasuries, that has all been in an effort to prop up the U.S. dollar. The whole strong dollar policy, all of this talk by all these secretaries of the Treasury, we want a strong dollar. A dollar is in the national interest. Everybody is trying to keep this house of cards propped up and prevent the U.S. dollar from collapsing and upsetting everybody's apple cart, where everybody sells to America and America consumes and pays with money that we print. So what I think people should be looking for as a sign of a loss of control is take a look at long-term U.S. treasuries and take a look at the price of gold. And I think if you could start to see a significant move up in long-term U.S. treasury yields while the price of gold is simultaneously rising, that is a pretty good sign that the end is near. Because the U.S. government is going to have to pull out all the stops to prevent yields from rising. But the only way they can prevent yields from rising is by printing more money to buy more bonds, which means they have to throw gasoline on the inflationary fire. And the U.S. Federal Reserve is not just going to be monetizing U.S. government debt. It's going to be monetizing the debt of all the state governments and all the municipalities. So think about the ECB and their problem and their moral hazard, and think about it in the United States. We got 50 states, far more than the nations of the European Union. So we have massive moral hazard. We have massive debt monetization and money printing. And initially, gold traders are worried that rising rates are going to prompt the Fed to tighten to fight inflation. When the gold market realizes that the Fed will never fight inflation, that the Fed will respond to inflation by creating even more of it, because they can't let interest rates go up. And when the gold market senses that, and you start to see gold prices rising with interest rates, I think that's the beginning of the end.
Do either of you want to comment on that? The Treasury yields rising simultaneously with the gold price?
I mean, last thing I checked, central banks' balance sheets were almost inversely correlated to inflation. They don't drive inflation. The velocity of money is an issue in itself. The debt demographics, technology, globalization, all of these things. So inflation per se, I don't think there's an inflation genie. There's cyclical inflation. Secular inflation, it's almost impossible. You really have to utterly destroy a currency to do it. And considering if we adjust them as a percentage of GDP, the US just isn't a feature yet. Japan has shown how far you can go. And they've got an independent currency that, not everybody owns. I mean, it should have collapsed. By all rights, the Japanese yen should have gone to zero. It didn't. So we don't know what the outcomes are. So we have to be intellectually honest with ourselves, is we don't know. And that's okay not to know. We just have to observe and make decisions as they come. But I don't see why rates going up and gold going up at the same time. And that's a pretty common thing in a reflationary bias. Yeah. I mean, it'll happen.
I personally think there are certain characteristics about Japan that make it more the exception to the rule. And I don't think Japan is going to get away with this indefinitely. And I think Japan is going to have a day of reckoning. But I think it's going to be small in comparison to America's. And I think a lot of people have derived a lot of false confidence by making these comparisons to Japan and saying, hey, look how long Japan got away with it. We can too, without recognizing the very substantive differences between the U.S. economy and the Japanese economy and the nature and the characteristic of our debt. And so I think that has created a false sense of confidence that, hey, we can get away with it because Japan did. I think a lot of people who believe that are in for a rude awakening.
I think what it, and this is, in many ways, I agree with a lot of stuff that Peter says. And the truth is, Peter and I probably agree on more stuff than we disagree on.
I agree.
But it's my belief that before this is all said and done, I think that we will see yields rising alongside gold rising and alongside the dollar rising, all in unison, because I think yields in other parts of the world may be rising even faster on counterparty concerns. And so all of these things about the day of reckoning happening in the United States and happening in Japan and happening in Europe can all happen simultaneously. The gold can go through the roof, yields can go up because nobody wants the counterparty risk of sovereign paper, and yet the dollar can be losing value at a slower rate than all of the other fiat currencies. And that means that relative to the other fiat currencies, the dollar rises while gold is rising and while rates are rising. So
yeah, look, anyway, it's possible, but I just don't think it's probable. And I think it would be a historical aberration if that were to be the case.
Well, on the other hand, I think the opposite. I think yields go negative.
Yeah.
Well, they're already negative in real terms. I mean, you're talking about nominal terms?
I'm talking about nominal terms. I think they go negative, and I think they stay negative, and it remains that way for a long period of time. I don't think the rate spike is coming. I don't think with central banks buying their own bonds, they just buy 100% of their own bonds. Something else will take the strain. It's obviously the currency market in the end, right? So if the US bought all its own bonds, put it on the Federal Reserve balance sheet, the dollar goes to zero. So Right,
but if they do that, though, then yields on corporate bonds or any of the bonds that they're not buying are going to skyrocket and the spreads are going to blow out.
No.
Well, no, because they have to create massive inflation to buy all those bonds. And so nobody...
They print money, doesn't create
That's inflation. What do you think inflation is? Okay. It's printing of money.
No.
Okay.
Yes, of course, that's what it is.
We're getting down to the definition of terms, but...
Yeah, well, I think it's important to understand your terms.
Okay, so what I want to go to next is is everybody who watches this show, they want actionable advice, right? And what I would like to hear from all of you at this point is, how have you adjusted your portfolios to survive the coming uncertainty? Where is your money? Like, let's talk about how we're actually actioning this within our bank accounts, with our wallets. And Brent, I'll start with you.
So I haven't changed my portfolio that much in the last 2 or 3 years. We still own equities, mainly U.S. large cap blue chip paying equities. I do think that there's going to be a pullback. I do think that we're going to see a correction again in equities. I doubt that we'll get as low as we got last March, but a 15, 20% pullback would be very easy at this point. We own short-term fixed income because, to Raoul's point, I think rates probably go lower before they have this spike that we've been talking about. Gold is in the portfolio, but we also have, an allocation to these asymmetric dollar trades. I continue to think that the dollar spike is coming. I think the dollar is going to be the surprise trade as well. And so, I think the idea is that if Peter's right and the dollar goes lower, me and my clients are going to be okay. But I'm positioned for me to be right, and then ultimately we'll flip to that other trade when I think the time is right.
Okay, Peter, over to you.
Yeah, well, I haven't changed my strategy in 20 years. I mean, I've basically been positioning for this since the dot-com bubble, since Greenspan showed his hand and lowered rates to 1%. I mean, I've been positioning for the end game of this monetary madness, and I've ridden out the cycles. We had a great ride from 2000 to 2010, made so much money in emerging markets, gold, oil, foreign currencies, and then, shorting subprime was kind of like a thing that I did on the side that just added to the gains of that decade. But then was surprised by the dollar strength in the next decade, and so we didn't do as well in the following decade, where we had a strong dollar and the U.S. market was the main game in town, and gold, declined from its 1900 peak. Remember, I started buying it was below 300. And we had a pullback in commodities and emerging markets. But during that decade where the dollar strengthened, the actual fundamental problems for the United States got much worse. And so we're in a much worse position structurally and economically than we were when I first adopted this strategy 20 years ago. And so I think that we're now, ready for the end game. Yes, it's taken longer than I originally thought, but I have never been this well positioned for this outcome. So we have big positions in commodity stocks, gold stocks, silver stocks. Also, I'm positioned in other industrial metals, copper, nickel. Emerging markets, I have bigger positions now than we had in the past, and in foreign currencies. Commodities, I have exposure to agricultural commodities. I think that the bubble got a lot bigger than I thought, but that means a lot more air is going to come out, and that means I think the trade ultimately is going to be a lot more profitable than what I first believed. So I'm just riding it out, and the whole time, even though we haven't had the ultimate crash, right, the real crash that I keep talking about and writing about, all the major macroeconomic predictions that I've been making over the last 2 decades, they've all come true. I mean, the things that other people were saying, the conventional wisdom, has all been wrong. I mean, think back to the early days of QE, when people thought it would end. That QE1 was the only time that they were going to do it. And I was saying we'd have more QEs in Rocky movies and QE infinity. And I said the Fed could never normalize their balance sheet. And when people were talking about, Donald Trump's going to pay down the debt. So the debt's going to be bigger than ever. You said we were going to win the trade war and our trade deficits were going to go down. I said, no, the trade deficits are going to go up. They're record highs. I mean, so all the things that I've been saying over the years have happened. We just haven't had the final collapse of the dollar. But since so much of what I said has been vindicated by the events that have unfolded, and since so many of these events have confounded all the so-called experts that were predicting the opposite of what indeed ended up happening, the only thing that has happened is that the stock market bubble has gotten bigger and the debt bubble has gotten bigger. So the illusion of prosperity has gone on longer. But ultimately, I think I'm going to be right in my analysis of the end game here, of the conclusion of a dollar crisis. And, even though we've managed to avoid it for 2 decades, I don't think we're going to avoid it for another.
Raoul, you've got the final word.
Yeah. So, I advise a lot of the world's biggest hedge funds, family offices, sovereign wealth funds, stuff like that. And in that portfolio, it's actually a mix. It's some gold miners, dollars, bonds, and a ton of crypto. Myself, I'm all in on crypto. It's the biggest bet I've ever taken in my entire life, because I have a lot of faith in unlike Peter, I think this is truly disruptive technology. I think digital value is real value, much like metal value is metal value. It's real, it's meaningful. There's a huge amount of money and adoption into the space. There's a ton of risks in the space, which gives it a very asymmetric risk reward if you can navigate the risks. And so, for me, it plays perfectly for the macro environment. I thought it was the most dominant macro trade I'd ever seen, and that's proven out to be true so far. Maybe I'll get egg on my face and everything reverses, but it's the strongest view I've ever had on anything over a period of time. Now, what happens after, in a year or 18 months? I don't know, but I'm definitely involved in the space because the whole digital asset space is exploding with super innovative technology, new business models. But right now, right for me, it's crypto.
Okay. Look, as expected, 45, 50 minutes in, I knew I'd still want to cover a ton more with each of you. And so what I'd say to anybody watching this is, I've had all 3 of these gentlemen on the show individually very recently. Check out those interviews, but more importantly, go to Real Vision TV, go to the Peter Schiff Show, find Brent on Twitter, and he's on every relevant podcast that I listen to and that you'll find in the market. Thanks so much for coming together and sharing this conversation with my crowd. It's a true honor, just listening in and steering a little bit. So I really appreciate your time.
Thanks so much.
Peter, are we going to run our bet back one more year?
Do you really want to make another bet?
The dollar's at 90.09 right now. I think that's a pretty fortuitous number. Sure, let's do it. A year from today, January 21st.
January 21st.
You're going to take under again?
I'm going to take the over.
The over.
Yeah, I'll take the over.
All right. I got to give you a chance to get some of your gold back. So I'll take the under.
All right. It's 1 ounce of gold. Today is 90.09. It's January 21st.
Yeah. One thing that happens, though, that gold coin keeps getting more valuable as we pass it around.
It does. Good thing I'm hedged with Bitcoin.
Well, that's not a hedge. You're hedged because you own some gold.
Yeah. It's all good. No, in all seriousness, Peter made a great call last year. I congratulate him, and his coin's in the mail.
You're a gentleman. Appreciate all 3.
All right. Well, hopefully I don't mail it back to you in a year. I just got to add another one to my stack.
There you go.
All right, guys. Take care.
Thanks, everybody. Appreciate it. Okay, I will now be joined by the executive team at my top gold pick for 2021. Welcome, Fury Gold Mines. What I love to do is introduce the right people to the right people. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, what's up, guys? Jay Martin here, CEO of Cambridge House, and I am joined by the team at Fury Gold Mines. I have the chairman, Ivan Bebek, CEO and president, Mike Timmins, and the senior vice president of exploration, Michael Hendrickson. How are you guys doing?
Very well, thank you.
Okay, so I'm glad to have you guys on because I've covered the Fury story a few times now on the channel. Obviously, I like it. We only have companies on the show that I like. And all of my newsletter subscribers received an in-depth report that we produced a few days ago covering all the assets of Fury, what I like about the story, any risk factors that I think investors should focus on. And I wanted my YouTube subscribers to hear that directly from you. And so I'm a shareholder. I built my position on the open market. Anybody watching this who sees what I see and likes what they see can therefore do the same. And so, Ivan, I first had you on the show last spring when you were running Orin Resources, and you were alluding to what you were going to do with Orin. This was the split that since occurred. You split Orin, which was a company with copper projects, silver projects, gold projects into 3 different companies. The first being Fury, which is what we're going to talk about today. So most of my subscribers are up to speed with that story, why you did the split. It was to simplify the story to receive adequate value for all the assets that you guys have had. And I think it resonates better with the retail investor now, because what we want to see is a clear path to profits. How are we going to make money? And what you've done is streamline these companies, I think, very effectively. But I want to start there, touch on the high level rationale for the split, why you did it. But more importantly, what I want to hear today is your thoughts on the management team that you built, why you chose the people that you did, and your vision, and what can we expect from you moving forward.
Great. Thanks. Again, it's a pleasure to be back. And it's nice to be here after you say you're going to do something and you've done it. And last year we advocated towards the split, and it's working out a lot better than we thought it would, which is great. Oren was around for about 5 years, raised $100 million, chasing some of the world's largest gold discoveries. That's how we started. Thanks to Michael Hendrickson and his incredible technical team, we've been able to go after some really, really big swings out there. We came up with quality across the 3 different asset groups: gold, copper, and silver. And you can't get paid for all 3 in one company, especially as an explorer, because you either align yourself with one type of the investor or the other, copper or silver or gold. It's hard to find people that want all 3. When we did the split, and we did it to unlock value, and so far, arguably a third of Oren is worth about 200 and something change Canadian, where our current market cap is in Fury. And today we'll argue that that's largely undervalued. We'll make some cases why. But the key element to that was bringing in a CEO that was capable to drive that business forward, and in this case, with a lot more capabilities than we had at Oren, which is Mike Timmins, who's with us today. First met Mike at Agnico Eagle when they were buying our last company, Caden Resources, in 2014. Found a lot of synergies with perspectives towards the market, towards high quality assets, towards the style of technical work we were doing. And so, tried for some time, actually tried for about 3 years to get Mike's attention. He finally became available. And we actually added an acquisition in to help grab his attention, being Eau Claire. And we assembled this company. So Fury started trading in October. It's had one of the most intense quarters I've seen in an exploration, now an exploration development company. Mike's done a tremendous job, fundamentally building out one of the best teams in terms of all aspects of the company are covered with superstars or experts in their own field. He's complemented very well with Michael Hendrickson, who's leading our technical charge. Our mandate as a group was to go after things that a major would go after. With Fury, it's to actually build potentially a major mining company in a rising gold market. So we have time, we have people, we have the expertise, and that vision is starting to come to a reality very quickly. And I'd say that things are going a lot better than the share price is currently representing. And people will soon see that as we start performing here in 2021.
Okay, thanks, Ivan. I want to pass it to you, Mike. You came from Agnico, company that trades somewhere around $90 per share, moving over to Fury. I know something special must have caught your eye. So, tell me, are you thinking you can build another Agnico here?
Well, I think that every company, develops its own culture and a way of doing things, right? And if you can reference Agnico, you can talk, B2 Gold, and even Caden or Oren Resources have many great tenants that we're going to follow and build out when we continue to build out Fury. You've got people first, deep core values, keeping the business manageable, keeping investors well positioned. But the most important, I think, is really mastering the basics. And as an explorer and resource developer, the basics for us means growth. And we're going to do that through large-scale exploration. To us, large-scale doesn't mean 27 drills on one deposit. It's a mindset of bigger sooner. The ability to demonstrate early the overall potential of a project, to get value sooner, obviously, and more efficient use of time and our owners' capital. We have 3.7 million ounces of gold across the platform at a 7.3 gram per ton average grade. That's a standout. But, it's also going to be our exploration mindset and the multiple asset approach, in my view, that's really going to set Fury apart. We're likely to drill over 100,000 meters over the next 18 months across the platform. We're going to completely open up each asset and show the market what true excitement and what geological potential really looks like. The vision, as we've said, is to build a mining company And in my view, the bigger the dream, the more important the team, right? And so the top three people of the company, Newmont, Goldcorp, and Agnico, we have decades of experience playing for the majors. All of our skill sets are around moving multiple assets, preparing for significant growth, and really thinking big, and having and being able to shoulder the big expectations that we need to shoulder, and what people expect from us. We wouldn't have got through the first 100 days of being a company. Established Fury, the amazing team that we have at Eau Claire, new geophysics completed over the entire mine trend, and drilling within the first 30 days of being a company, if it wasn't for the excitement, passion, and the caliber of our entire team. And so in our view, it's big action plans equal big gains in value. And that's what we have lined up for shareholders in 2021.
I love it. You know what? Every time I talk to somebody at Fury, the thinking big, the big action, the bigger, sooner narrative comes up. And I know, Mike, when we discuss, where did the name come from, Fury? Because I love it, right? It really encompasses the culture. I mean, every time I talk to you guys, it's all about aggressive plans, move forward fast. And it's every conversation I have with the team. You can see it in the culture. I love that. And Michael Hendrickson, I want to pass over to you, Senior VP of Exploration, background at Newmont, now the largest gold producer on the planet. And if you could touch on the assets specifically for us and what you think investors should be focusing on.
Well, I'd echo the sentiments of Mike. I mean, this is all about growth. And I think our exploration drill program demonstrates that. For instance, at Eau Claire, we took a real mindset of time value. Let's get the first exploration drill hole, 700 meters away from any known resource. When you get indications that you can be on it at that point early, you can better plan for the future. And that's what we're about, So really, that's where my mindset is on every asset. If we go to Homestake Ridge, it's about expansion and meaningful expansion quickly, and that's going to be our plan this coming summer. Up at Committee Bay, obviously, we're in elephant country. We've spent a great deal of time perfecting our targeting techniques. And, now when we go up there, we can be very surgical in our exploration drill plans. And that's going to be a huge catalyst for Fury going forward, world-class discovery in the Arctic. So I think that's just the general feeling around our technical group. Let's be aggressive. Let's know early. Let's take those risks and get our plans set for the future.
Right on. Okay. Like Peter Brown was on my stage last January screaming, if you want to win big, you got to bet big. Okay, Ivan, I want to pass it back to you. The reason that my head first turned to Fury was because you've done it twice before, right? And success begets success. And everybody who watches this knows that's my strategy. I follow the winners around the industry, whether they're the entrepreneurs, the supporting cast, or the money. With Keegan and Caden behind you, you've hit 2 home runs. When somebody's hit 2 home runs and they get to the plate again, you should pay attention to what they're going to do next. So my question for you is, what do you have this time with Fury when it comes to the people, the assets that you didn't have in your previous wins? What strikes you about this opportunity?
Great. Well, first answer there is experience. And, the second answer is the people, as you've heard from both Mikes here, Mike and Michael. We've talked a lot about big projects. We talk about, time value concepts to get there sooner, the bigger kind of swings. Everything we talk about with you here relates to a big share price. And that's really what we're going after, because it's a fundamental, instrument in our business plan to get bigger and then to grow with acquisitions, M&A down the road. I think for me, when I look back to Keegan, which went from 49 cents to $9 a share, a $5 million company turned into a $900 million company as a first success. This is 3 times that in terms of opportunity. We think that each of these assets could deliver a Keegan success and more. And you said what's really different, and I've commented on people. Michael Timmins' background from Agnico Eagle. I mean, he was the VP corporate development, and he was there for a very, very, very intense growth phase of Agnico that made it what it is today, which I'd argue is one of the best gold companies in the world. And let's not be too excited about the value of something in terms of, if you create a $100 billion company, great. But let's talk about the share price. Agnico trades at $90 a share. I mean, I'd love to see Fury trade at $90 a share. Here's a guy that went through that, and he saw that in intense detail for the entire growth phase. So I think the biggest difference for me is the caliber of experience we have, We've upgraded our technical team dramatically, and we have a really strong CEO at the forefront that's seen this kind of growth before. So for me, Jay, it's massive improvement. We got better over time, and we're just getting started.
I love it. Okay. And Mike, maybe the most important question that investors want to know, what's going to move the share price for us in the next 12, 18 months?
Look, I'm super excited about demonstrating to the market that our assets not only have immediate expansion potential, but every project has the chance for that next new major discovery, right? And of course, that was by design when we assembled Fury. At Eau Claire, it's a dramatic rescaling. At Homestake Ridge, it's a reintroduction of that asset to the market via the drill bit. And Committee Bay, which is Elephant Country, a step change really in the way that we approach and in the way that we're going to grow that asset with resource growth and additional discoveries, right? We're going to have a wall of continuous activity, catalysts, news, which are going to benefit shareholders greatly, but also make it very easy for us to tell our story and for guys like you, Jay, to tell our story. So active all year, increasing in scale and find more gold. It's a simple approach, and we're really just getting warmed up.
I love it. Okay, Michael, I want to pass it back to you to wrap it up. Now, I harp on my people over everything strategy all the time because I'm willing to lose sleep over finding the right people. I want people like you to lose sleep over finding the right rocks. So talk to my audience right now about what you're most focused on.
Well, quite simply, Jay, we're focused on the growth and the potential of the expansion of each of our assets in terms of its gold ounce resource base. We see that there's a great deal of discovery potential across all of our assets. And our job now as a technical group is to go after that, to be bold, to go for discovery, to go for expansion, and to do it in a disciplined manner, right? And that's what our technical group is going to bring to the table. But certainly from our standpoint internally, we do see that growth profile. We do see that discovery potential that could be a game changer for Fury moving forward.
Okay, I appreciate that. So look, we're going to stay on top of this story. Mike, you touched on the drill program you guys have running. I think we can expect a steady flow of news for the next 12, 18 months. We're going to stay on top of it here. Thank you all for your time coming on and explaining this story in depth to my audience.
Thank you, Jay.
Thank you, Jay.
Thank you.
Okay, thanks for tuning in today. Now, my next guest is Grant Williams, the author of Things That Make You Go newsletter, one of the most widely read financial publications in the world. He's also the host of the Grant Williams podcast, one of the top ranked financial podcasts in the world. This was one of the top 5 interviews I have ever done, and I really hope you enjoy it.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
All right, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Grant Williams, the author of Things That Make You Go one of the most widely read financial newsletters in the business, and the host of the Grant Williams podcast, again, one of the most listened to podcasts in the business. Grant, it's good to see you. Welcome back.
Hey, buddy. Yeah, good to see you. It's been a while, right? It's certainly been a while since we saw each other in person.
Yeah, it sure has. And the last time we had you on the show was March or April, when this global pandemic first we began to realize what it was. Could have been 10 years ago, given how much has changed since then. But it's good to see you again. And I want to run through a variety of topics with you. I thought a good place to start would be this Reddit short squeeze scenario, because I recently listened to one of your podcasts with Bill Fleckenstein, and your guest was Mark Cahodes, 2 of, I guess, what you described as the most accomplished short sellers in your network. Mm-hmm. And you guys jumped into the narrative that the media is kind of layering on top of this. So why don't we start with that, Grant? Because you guys had some really valid points in terms of short sellers being bundled into a basket of evil and retail investors being bundled into a basket of good. And it's this binary perspective, which obviously isn't how things really work. So what are some of the most important points that people are missing right now, Grant, when it comes to that scenario?
Well, I think, this is something that I've talked about a lot over the years, this narrative that short sellers are evil. And it's been very carefully constructed, because we as human beings, we need a villain. We need an easily identifiable villain that we can say is, it used to be in the Westerns, the guy would wear a black hat, so you knew exactly who the villain was.
Yeah.
And it's the same with short sellers, right? People point to them because markets are supposed to go up. If the market goes up, everybody gets richer. And if the market goes down, it's a bad thing. Up is good, down is bad. And so anyone that profits from the market going down is very easy to demonize as a bad guy because they want the market to go down. What could be more un-American than wanting the stock market to go down?
Right.
The reality of it is way more nuanced than that, which is the point we were trying to make in this podcast. There are different kinds of short sellers. And the guys who, everyone's heard of a pump and dump scheme, which is where you run these penny stocks up, you buy your own shares, you sell a great story, and when all the retail comes in, you sell them your shares, you walk away clean. The short sellers on the downside do a similar thing in reverse. They'll short shares, then they'll put a scandalous article out and drive the shares lower, and they'll cover their profits and walk away. Now, there is no difference apart from market direction between the pump and dump artists and those kind of scammy short sellers. None.
Right.
But how often do you read long articles about how evil pump and dumpers are, right? You just don't do it because they get lost in a generally rising market. Right. And they're not so easy to kind of pick out. Alongside those guys, there are real short sellers. There are guys like Mark Cohodes who seek out fraudulent companies who are up to bad things, and they go after them. They try and put nefarious CEOs in prison. They try and expose companies selling fraudulent products or running bad numbers. People forget Enron was exposed by short sellers. Tyco was exposed by short sellers. MCI Welcome. You go through just about every big corporate fraud in living memory, and all of them were exposed ultimately by short sellers. And so that kind of little corner of the short market is, I think, incredibly important to protect. Those guys should be actually protected and not vilified and hounded out of town because they provide a very important check and balance on a system that is heavily overloaded in the other direction.
Right. They're like
alongside,
the
yeah, exactly right. But alongside that, and here's where the Reddit GameStop thing comes into play. You have hedge funds who, by the very nature of the name of them, are hedged. So they have long positions, they have short positions to hedge them. Now, sometimes those short positions become, like the GameStop was, ridiculously over-leveraged. So when you have a company where there is 120% of the shares sold short, and I remember this from the days when I was trading Japan back in the day, this is a really easy short squeeze, right? We had companies buying back their own shares to the point where the shorts were in a no-win situation and holding them to ransom. Those are the guys that have triggered this. It's not the short sellers of the world. It's the people who are levered short, and there is a very important difference to understand. They're not short sellers as people understand them to be. They're not evil guys trying to profit from companies going down. They are trying to profit from a particular situation that they find in a stock that they think is going to go lower. But the addition of leverage to that position is what causes the problem. Anytime you have extreme leverage, that's why these things move so far, so fast. So what we've seen is actually some very smart work on behalf of some of the guys in the Wall Street Bets bulletin board, identifying the situation, identifying the fact that these shares were way too short, the leverage was way too high, and this was ripe for a squeeze. That was tremendous work. The problem comes when it becomes something that retail is basically strongly encouraged to get involved. Because unfortunately, just because of the rules of this game or any game, by the time the retail investors are aware of this, two things happen. One, the game to some extent has passed. And two, they're encouraged to do things that they really don't understand. Right. And so what we saw was a ton of people piling into GameStop at $300-400 because, hey, this is the easy way to make money, have fun staying poor. And if you're not holding on, you're crazy. And all the stuff we saw, which to unsophisticated investors sounds great, and everybody's making money and they're going up every day and people are popping champagne corks and buying Lamborghinis on Twitter. Yeah. And they get sucked into that because man has a fascination of wealth without work. Of course, a few days later, the people who paid $300 or $400 are staring at $60 in the face and wondering what happened to most of their money. Mm-hmm. That's the real shame of this. So, these things never end well, unfortunately, for retail. Finance is a very complicated game, and I totally understand the impulse to stick it to Wall Street, right? I totally understand where that comes from. I've been writing and talking about it for a couple of years now. Yeah. And it's justified. It's hugely justified. But the ire that's pointed at evil short sellers is misplaced. If people actually took the time to really understand how we've got where we are and how the game is actually rigged, they would understand that the game is rigged at the central bank level, not the hedge fund level. The central banks rig the game for the hedge funds. And the hedge funds have basically reached the point where the Fed and other central banks around the world are captive because they've gone so far that if they step away from backstopping the financial system now, the whole thing falls over.
Right.
So what the central banks have done to Main Street is way more egregious than what the hedge funds have done to Main Street, but it's that much more difficult to understand. And so identifying this villain, you put this villain up there, the evil hedge funds, evil short sellers.
Right.
And it's very convenient and it gives people a focus for their anger. And in some cases, it's rightly placed. Some of these hedge funds using too much leverage, some of these short sellers that are scam artists, totally right. But bracketing them all together and not acknowledging the damage done by central banks' policies for the last 10, 20, 30 years, I think is to miss the point significantly.
So you touched on something there, too much leverage. And I think that's one of the core issues right at the root. But can you define something for us, Grant? Because you mentioned there is 120% short position on GameStop. So explain what that means.
Well, if you are shorting shares, you are supposed to borrow the shares first, right? So let's say a pension fund holds a load of GameStop shares in a big fund. The hedge funds will go to their prime broker and they say, I want to borrow some GameStop shares. And if they have availability of the shares, they'll lend them the shares, which they then sell into the market. And they will cover them back as and when, either for a profit or a loss. And they'll pay the prime broker a VIG for the use of the shares, which most of which gets passed on to the actual end owner of those shares. That's how you're supposed to do it. But oftentimes you have people doing what's called naked shorting, where they don't borrow the shares first. They sell the shares short, thinking they can scalp a profit before it becomes a problem. That's how you end up with 120% of the shares sold short. People are naked shorting. And once that happens, obviously, that's where the squeeze comes in, because that extra 20%, they're not. You can only deliver them by going into the market and paying whatever price you have to pay. So if the people are lending the stock out, say we want to recall our stock, everyone that's borrowed that stock has to cover their positions and send the shares back. And there's, it's like a game of musical chairs. There's one share too few, and there's 20% shares too few, and so people have to cover them back at the prevailing market price. Right.
Okay. Now, what are your thoughts on, so Robinhood halted purchasing on, I think eventually ended up being about 35 stocks that were available only to be sold. So I think now we're kind of learning there was a liquidation crisis, right? They were insolvent for a period of time and had to make that decision at a platform level. But again, Grant, like, what are your thoughts on that decision? Was it the right thing to do? Was it the only thing to do? And how does that impact retail? And most importantly, how does that impact retail investors' perspective of what's going on?
Well, they didn't really have a choice. To be honest, the real problem here is that the CEO of Robinhood went on CNBC that morning and lied to the public. He told them they didn't have a liquidity crisis. And later that day, in a clubhouse room with, of course, Elon Musk, he admitted that they had a $3 billion margin call they couldn't meet, and they talked the regulator down to $770 million, and then went out and promptly raised $2.4 billion from investors.
Right.
That used to be called securities fraud back in the day, right, when markets were actually properly regulated. So what they've done in terms of freezing access to the accounts, freezing access to certain shares and avoiding people being able to open new positions and stuff, that's nothing new. That's not something that came out the clear blue sky. And again, it comes back to the earlier point about the people getting into these things, not really understanding all the rules of the game. They didn't do anything untoward, technically speaking, right? Going into that, if you understood how Wall Street works, you would have understood that there is a chance here, if the volatility gets too crazy, that they will raise margin requirements. There are all kinds of things that can happen that mean this is not a simple trade that you can do whatever you want any day of the week guaranteed.
Right.
To me, the real problem here, and it's the thing that people aren't talking about and they should be, is the fact that because of the behavior that's been allowed to go on over the last 10 years, particularly at a corporate C-suite level, the malfeasance that's been allowed to go unpunished, these guys are happy to get up on CNBC and say we had no liquidity problem. It's a flat out lie. And if you can do that on TV and there are no punishments, and again, Elon Musk's famous funding secure tweet, I mean, here's a guy who committed securities fraud
Yeah.
Gets a $20 million fine, but meanwhile makes multiple billions in the value of his stock. These guys are going to do this all day long. They're going to pay the fines. It's a tax on doing business. They'll pay the fines when they know that no one's going to jail, no one's going to get any severe punishments.
Mm-hmm.
And that's what undermines securities markets. It's not clearing brokers having margin calls and having to restrict the volatility, having to restrict access to people's accounts. That's not what's ruining and undermining securities markets at all. It's weak, I would say, absent regulation on the part of the SEC and their ilk.
Right. Okay, now, last question on this topic is maybe stepping back a little bit and talking about the bigger implications at like a society level. 2 weeks ago, I had the privilege of sitting down with the 22nd Prime Minister of Canada, Stephen Harper, and a lot of that conversation was focused on the rise of populism and the divide within populism and the little events that have occurred to stimulate that divide. And you mentioned on your podcast with Mark Cahotis and Bill Fleckenstein a couple of weeks ago that was maybe your biggest concern, right? Is what's the perspective that's, I guess, ingrained in people when they go through this event. So what's your biggest concern, or what's the worst case scenario, I guess, at a cultural level?
Well, look, this fracturing of society is evident for everybody to see. We can all see that, right? And the pandemic and lockdown has only exacerbated that. We've just gone through a very nasty election cycle in the US. And this idea of conflict is everywhere. It's in every direction, right? It's left to right. It's old to young. It's rich to poor, and it's Wall Street to Main Street. And again, this wealth inequality, which is what this all stems from. Let's make no mistake about it. This is the 99% feeling like they're not getting a fair shake, and they're not getting a fair shake. The rich are getting much richer. The billionaires are getting more billions to their name every day. And that, again, I'm afraid it sounds like I'm just droning on about the same thing, but this comes down to central bank policy. If you make the cost of capital 0% and you keep it there, and then you tell everybody, whether implicitly or explicitly, that we've got your back, and if shares go down, we're going to step in and backstop you. Guess who's going to make money? The people with access to capital. Is that the poor in the world? No, it's not. It's the wealthy. So the wealthy get access to free capital, to free leverage, and an implicit backstop that whatever they buy is not going to be allowed to fall, and they make hay. And it's very, very clear where this has come from. Now, on the back end of it, when you look at how fractured society has become, you worry about boiling points being reached. And I think that was, I did an interview at the beginning of 2020, and the host asked me what my biggest fear for 2020 was, and it was social unrest. I said, I think this year is going to see a tremendous amount of social unrest. Now, obviously, I didn't know about the pandemic at that point, and
right,
know exactly how the US election cycle would go, but this has been brewing for some considerable amount of time. And seeing, and I was going to say I hate to keep picking on him, but I don't. Going back to Elon Musk again, seeing the world's richest man using his influence to pump up penny stocks and, change his Twitter header and put Bitcoin in there, or GameStop or Dogecoin or whatever it is, so he can make another couple of $100 million out of it. I mean, it's shameful, frankly. It's just shameful. But again, it shows what happens when you enable people to think they're above the law. So I think what we saw in the US election cycle is a taste of things to come. I hope that that particular country can come together, as the UK has kind of done post-Brexit. That was another debate filled with animosity on both sides, and now it's done. It's out the way. People have calmed down about it a lot. So hopefully that can happen in the US. But make no mistake about it, the rich-poor divide is also, you can pretty much put it into a boomer Gen Z divide, millennial divide as well. So it's not just rich and poor, it's old and young. And right now, the boomer generation still have the reins of power. They're still the most broadly represented in the lawmaking chambers of the country, right around the world. But the millennials are starting to wake up. They're starting to feel aggrieved, as they should be. And they're going to start trying to put their own representatives into the House. And for one thing that I'm watching for is to start seeing a slew of young congressmen and women in the States, young senators and young MPs in the UK and across Europe. That, to me, tells me that the day is drawing near where if you're a boomer, and you've made your money, you better start thinking about how you're going to hang on to it, because I suspect there's going to be all kinds of redistributive policies getting championed, and if they have their own way enacted, and that's going to be the only real way to redress this balance, unfortunately.
I like that perspective, because that's like I was going to ask you, how does this unfold? And I was hoping we could find some sort of, I like to find the optimistic thread if I can, and stepping back and watching this, it's easy to just get lost and think, okay, 2010, we had, Occupy Wall Street on the left and sort of the Tea Party forming on the right. And then fast forward to 2016, Bernie Sanders and Donald Trump, sort of the representatives of these ideas as they evolved. Fast forward to today, it's, Antifa on one side, QAnon on the other, and it's accelerated this divide. And I wondered, I know you're such a student of history, if we've ever seen this before. And my mind goes maybe to like the 60s and the 70s in the US. There was some serious unrest that probably at the time looked irreconcilable. And so maybe you've answered my question, but is that the how do you think this plays out in the next couple of years, Grant?
Well, look, of course, this is nothing new. We've seen these times before in just about every country on earth. The difference here is we have an extraordinarily dangerous accelerant in the shape of social media. And that's what we didn't have in the 60s. So it wasn't so easy to coordinate rallies. It wasn't so easy for all this stuff to take place. It wasn't so easy to spread fake news, for one of a less trite term. Now that's the easiest thing in the world to do. And people realize that, and they use these tools, not necessarily the way we all thought they'd be used when they came into our lives a decade or two ago, but they're being used as everything is, right? As a means to an end now. And if the end is power in the shape of politicians, then these things are going to be used to create power. And how do you create power? You build a base, you galvanize that base, and you demonize others. And that's a great shame for social media. As a parent of two millennial children, I despair for that generation and the ones that follow, because it's going to be so difficult to try and fight against the bombardment of vested interest trying to make you think a certain way, trying to make you feel a certain way.
Yeah.
But that's how it works, right? You don't build a base of power without animated supporters who believe in the cause. And so I think that's the big difference between now and, you used the example of the 60s, which is another great example. But the difference then was we didn't have social media. You couldn't galvanize a group worldwide. It was local rather than national and international.
Yeah, man, you remind me of a conversation I had 3 years ago or so with Christopher Wiley, who was one of the early employees of Cambridge Analytica. We remember that name from the 2016 election and all this. And he was walking me through sort of the work they did, where they would create thousands of fake social media personalities and form communities around radical ideas with the intention of speaking to somebody who had a thought in their head they weren't comfortable vocalizing, but then they found a community online where it was normal and accepted to think that way, right? And that's how they opened up these vulnerabilities. Fascinating. Everybody should look into that story. Okay, I want to pivot because I also want to get your thoughts on markets and commodities and what your portfolio is going to look like for 2021. Starting just with some thoughts on the various sovereign debt crises that we're running towards. And, I recently hosted the virtual version of the Vancouver Resource Investment Conference here in the channel. I had about 70 conversations with amazing thought leaders. And, I can't help but pick up on where there's consensus after that many conversations in such a short amount of time. And consensus certainly lands that we are in some version of the logical conclusion of our financial system as we know it, right? How that's going to unfold, when that's going to unfold, and what's going to happen next is open for debate. But what are your thoughts, Grant? I mean, you host a show called The End Game. So I'd love to get your thoughts on where you think we're at, what developed sovereign nations are more at risk than others, and your broad outlook for 2021, and then we'll jump into some details.
Yeah, well, look, it's interesting because these sovereign debt crises have been brewing for years now. And again, the only thing that has stopped them has been the increasing insertion of central banks into the process. I was reading this morning, I saw a chart that said that the ECB had bought 85% of sovereign issuance in Europe last year and 100% essentially of the southern European economies. Now, if you think that is sustainable in the long term, I don't know what to tell you. I mean, it just doesn't work. But again, going back to the point we were talking about earlier on, this idea that the central banks are so far into this now that they can't turn back, I think is very important for people to understand. They can't wean these guys off, the central bank being the backstop for their debt, and they can't do it at a time when everybody's deficits because of COVID spending, because of fiscal stimulus, are blowing out to places that they haven't seen probably since World War II in most cases, and sometimes beyond that. So, when people talk about a sovereign debt crisis, realistically speaking, it's a central bank confidence crisis. That's what people need to look for, is look for signs that the central bank policies are losing their efficacy. Whether it's auctions that don't go so well, whether it's central banks suddenly starting to have to buy 90% of issuance as opposed to 85 just to keep the wheels on, which I'm pretty sure is going to happen. I think watching the central banks, watching the sovereign bonds is not really going to give you a heads up as to when things might be reaching the critical point. You have to understand how those prices are staying where they are, right? You have to understand what it is that's keeping bond yields so low. And the answer is simple. They cannot be allowed to rise, because if they rise, with the fiscal position of every single one of these countries, frankly, the whole thing is unsustainable. So it just doesn't work. And we have currency runs, we have all kinds of problems. So the sovereign debt crisis will be triggered by a crisis in confidence in central banks. And I don't know when that happens. I'm amazed they've managed to get away with it so long, but this ocean of liquidity they've been supplying has helped them do that. Their Achilles heel, and I think this is probably the biggest topic that people need to think about and decide where they stand on it, and for the coming year or maybe the next 3 to 5 years, is inflation. Inflation is the one thing that can really take the decisions out of these guys' hands. And by inflation, I don't mean asset price inflation, which has been great for the people that have assets for such a long time.
Right.
We start to get consumer price inflation. We start to get wage inflation. We start to get raw material inflation, which we're seeing already quite obviously in many places. That's the point where the Fed has to start making some drastic decisions. And I use the Fed as a proxy for all the central banks in the world. They've already said that they are, as opposed to 2% as their inflation target, because it's undershot for a while, they're going to let it overshoot for a while, which is a smart move on their part, because it allows them to talk soothingly if inflation gets to 3% about, we're just going to leave it here for a little while and then it's going to come back and it's going to moderate back to 2%. But if 3% turns to 4%, and it gets a tailwind behind it, particularly if inflation expectations are climbing, then this whole thing becomes much, much harder for them to manage, because you can't really keep bond yields where they are when you have inflation starting to creep higher significantly and dramatically. And so, that Endgame series that we've been doing, Bill Fleckenstein and myself, we've talked to a bunch of people way smarter than the two of us, and there's great division in this camp still. Lacey Hunt has been a 40-year deflationary advocate. He's been right for 40 years essentially. He's still on that train. Russell Napier has been on that train for 20 years. He's hopped off. He's now believes we're going to get significant inflation, if not by the end of 2020, then certainly in 2021. David Rosenberg's still on the deflationary train. There are other great thinkers who are on the inflationary train. And that, to me, is the one thing that everybody needs to think about, to read about, to listen to people's opinions, and for their own portfolios, have an understanding of, okay, first of all, do I believe inflation is coming back? Because after 40 years, essentially, of deflation, portfolios around the world are not structured to do well in inflationary times. So if you believe inflation is coming back, you need to have a good long look at your portfolio, understand where the stress points are, understand what you can do to first of all safeguard it against inflation, and then perhaps make some money out of it. If you believe that inflation is not coming back, that's fine. But I think we humans have a problem with extrapolation. And so because we've been on this long deflationary run, the easiest thing in the world for people to say is, we don't have to worry about inflation.
Right.
And look, since the 1970s, you had 40 years when you didn't really need to worry about inflation. But if you look back and read some history around the 60s and 70s and you see what happened and you understand how quickly inflation can grab hold and how much damage it does to wealth, to savings, and to currencies, then you realize that it's a potential outcome that you absolutely have to take seriously and understand the effect it might have on you, and then handicap whether you think it's a big problem or not.
Right. Yeah, that recency bias, we're all a victim of that. I can speak personally. So then let's talk about how we safeguard ourselves, Grant, in a scenario where we can't be certain we're going to see increased inflation, but it's a possibility that we're concerned about. How then do you modify your portfolio to protect yourself? Well,
if we end up in a period of inflation, then the simple thing is you don't want to be in bonds, right? That's not the place you want to be. And one would argue with bonds at 5,000-year high prices, if you think there's even a small chance of inflation coming back, then you've been given the perfect exit for at least to trim your bond portfolios down. And people, again, people think their bonds have done really well and they're loath to get rid of them. But the simple truth is they've only done well because of the central banks. That's why they've done well. So again, you come back to this idea that you have to decide whether you think central banks are going to remain omnipotent for the foreseeable future. If you think they are, it gives them some leverage over the bond market. But if you think that is fraying, that confidence is fraying at exactly the same time that inflation may be making a comeback, then having a big bond portfolio is a crazy idea. Yeah. Equities tend to do well in inflationary periods, but again, we have stock markets at all-time highs, and that's largely down to the passive investment phenomenon, which tells me that you should be looking at value stocks, at growth stocks, not momentum stocks. And that takes me to commodity producers. I look at the commodity complex, where you're starting to see some really good confirmation in terms of charts that the recent strength in commodities is a decent base on which to build. So looking at commodity producers who have all had a pretty rough ride, many of whom have got their balance sheets in much better shape since the last bull run, necessarily so, and they do offer value. We've seen a great run in uranium stocks recently. That those were priced extraordinarily cheaply. So I think we're going to see a return to value over growth. It may not come overnight, but it's starting off on such a low base that you give yourself a very good chance of doing well if that inflationary environment starts to kick in. You're having the opportunity to sell your bonds at 5,000-year highs, right, and buy inflationary reactive growth stocks at relative lows compared to extremely overvalued momentum stocks in the market, which I think is a sensible trade. Precious metals obviously are a good way to protect wealth, even if you just use them as a liquid reserve before you use that cash to buy something else. And then cryptocurrencies. Look, I don't spend a lot of time talking about cryptocurrencies. I have my views, but they're not as useful to people as those who immerse themselves in this space are. So I really don't like to talk about it because I just don't think my views are worth that much. But Bitcoin as an inflationary asset is obviously a good idea. As a stable store of value, I think anyone that's bought it because I think it's a stable store of value has had several sleepless nights realizing that it isn't that. When it can go down 20% in a matter of hours, that's not a stable store of value. But will it do well in inflation, an inflationary environment? I would think so, unless we see more regulation, we see more see the cryptocurrency community being hamstrung by regulation and by jealous central banks desperate to roll out their own currencies. So I think there are plenty of tools by which to play an inflationary future, but the first thing you have to understand is A, what damage could inflation do, and then B, do I think inflation is the likely future? Because maybe you believe there's going to be more deflation to come.
Okay, thank you for that. Now, back to commodities. I mean, it makes logical sense. Sell things when they're expensive, buy things when they're cheap.
You'd think, right? You'd think. Try selling that to the people who bought GameStop at 400.
Yeah, I know. You know what? I'm optimistic though that we've created a whole population of new investors who are now watching the market and understand, maybe this wasn't the best entry point, but
see, that's interesting you say that, Jay, because I would think the opposite is most likely to be true. That you've created you've created a small subsection of a generation that have made a lot of money, but you've also created a ton of people who have lost 80% of their money, really important stimulus check money, overnight. And I don't know, maybe they think it's all fun and it's gambling and it doesn't matter. That may be true, but I fear that the opposite is that these people can go, well, I got burned in the stock market once, fool me once, shame on me, right?
Yeah. And I think you're right on that point. I think the majority, unfortunately, will likely get washed out. I've taken it on as a personal mission, though, to reach out via our content to get in front of as many of these new traders as possible and say that's not the best strategy.
Yeah, good for you.
You could apply some patience, develop a strategy, and stick to your rules. This market isn't a get rich quick scheme. It's a go broke fast scheme or a get rich slow scheme. But if you can come up with your strategy, trust your process, have patience, all that stuff.
Yeah, very good advice.
Okay, so back to commodities. You touched on inflation as a main driver. Outside of that, Grant, are there any economic trends that would support your commodities thesis? And then equally as important, that we could watch to discover that, we're wrong. What we thought would unfold is not unfolding.
Well, look, I think you're going to see a tremendous amount of infrastructure spending. I think that's a clear and obvious way for new administrations, the Biden administration for one, and others to open the spigots without just sending stimulus checks to people. So I'm confident we're going to see that the Belt and Road Initiative is going to keep growing, and I think you'll see infrastructure projects as a friendly way to print money right across the developed world. If you look at the amount of investment that's gone in to mining projects, it's some of it. The gold space particularly. So I think it's at 60-year low. The amount of money being invested in finding new resources.
Right.
So you kind of have this perfect storm of low prices, low stockpiles, low discoveries. Companies with improved balance sheets, and it's just waiting for that inflationary spark to give it a tailwind. In the meantime, as I said, it looks to me like commodities have bottomed. It looks like there's a base building, enough of a base where when you start talking to people about owning commodity producers, they don't just laugh at your face and point you back towards Netflix. And that's the first thing that you have to have happen. You have to have people actually be prepared finally to listen to the story. Now, it'd probably take them 3 or 4 times listening to it to actually act on it. But that's what gives first mover advantage to people who are willing to look ahead and say, look, I know value stocks are on the nose at the moment. I know people don't like value stocks. It's all about growth. That's why you can pick them up cheap. And if you see that bottom in commodities, you see the potential for inflation. There's no guarantee it's going to happen. There are enough stars lining up, I think, that you can start to allocate carefully to that space and broadly to that space, because I think it's a tide that will lift all boats in the commodity sector.
Got it. Okay, now I'm running up against the clock here with you. Actually, a question I definitely wanted to ask was, last time we spoke, a gentleman in Moscow. I don't know if you can see it on my bookshelf there.
I see it up there, yeah.
Your book recommendations. I picked it up because you told me it was one of these books that I read the last page, I flipped it over, opened it up again, and read it the second time. And it was, what an awesome read. Yeah, thank you.
Isn't it great? No, it's I think it's a wonderful, wonderful story. And if anyone watching this hasn't read it yet, I can't recommend it highly enough.
Awesome. Okay, so I got to hit you up. What do you have for me this time?
Oh, book recommendations. Oh, wow. Okay. Well, I'll tell you the book that I've actually been listening to it while I've been walking the dog is Malcolm Gladwell's new book, Talking to Strangers, which is, it's all about the problems we have as human beings recognizing strangers. And, Harry Markopolos is in the book, but it deals with a phenomenon called default to truth, which, human beings have. We tend to, our default is to believe that people are telling us the truth, which is why it's so tough to spot liars. And it's a fascinating book. I would recommend the audiobook because it's the way he's done it is it's not just him reading the book. The interviews of people he's put in the book, he plays you the tapes of the interviews. It's an incredibly immersive experience. But I think it's if you listen to it or read it through the lens of an investor, I think you'll find it very useful in terms of the next phase of these markets, where I suspect we're going to go back to where we were in the late 90s when, kind of the Enron phase, where suddenly the famous, Buffett, when the tide goes out, you find out who's swimming naked. That feels to me like one of the next phases we're going to go through. And so understanding how to recognize when people are lying and understanding how strangers can deceive you, I think is going to be, sadly, a useful skill to kind of burnish. So I would definitely give you that recommendation. I've just finished it, and it's a tremendous book.
Okay, cool. I'll pick it up right when we get off this call. I like it. Sounds like it adds some useful tools to the tool belt. So
I think so. Yeah, I do. I really think so.
Okay. Now, where can people find you? I know you're at grant-williams.com, correct?
Yeah. Yes, indeed. I just launched a new website. It's been a long time coming, and it's been overdue, and I'm delighted with it. The website is grant-williams.com, and you'll find my podcast series there, and you'll find things that make you go, You can find out everything you need to know. There's a bunch of my presentations on there. It's all there in one place, finally.
Awesome. Okay, that's great. Look, Grant, it's been great catching up with you. Thanks so much for your time.
Anytime, mate. Good to see you, as always.
My next guest is Danielle DiMartino Booth, the CEO of Quill Intelligence and the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Enjoy.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I am joined by Danielle DiMartino Booth, the CEO and Chief Strategist at Quill Intelligence and author of the bestseller Fed Up, an insider's take on why the Federal Reserve is bad for America. And Danielle's probably the only person I've met who's qualified to write that book, because she spent 9 years at the Fed Reserve Bank in Dallas, where I think you're the direct advisor to the president at the time. Is that correct?
Yes, on all matters financial markets, kind of where the intersection of the financial markets and economic data, where they meet. That's what my main duty was to him. So,
okay, well, thanks so much for coming back on. It's good to see you again. Good to reconnect.
It's great to be here.
Well, there's 100 different directions that we could go or start this conversation. And we covered a few of them before we hit record here. But, chaos has kind of become the status quo when you're looking at the markets, macro finance, whatever. And one of the hardest parts of being an investor these days is cutting through that chaos, cutting through the noise, and determining, what you should really be focusing on, getting away from sort of the trend, highlight, headline of the week. The first question I want to ask you, therefore, Danielle, is when you get up in the morning and you start your day and you crack the laptop open, what's the first thing you check when it comes to the markets, news flow, et cetera? Where do you go first?
So it's a very recent shift for me that I have finally stopped going to the virus data. So I think that in and of itself, I'm starting to revert to my pre-pandemic self.
Okay.
Where I can go and look at the financial markets, see where futures are, see where we're going to open. I always look at the 10-year and see where that 10-year benchmark treasury yield is coming into the trading day. Those are the things that I look for at the beginning of the trading day. If you ask me what I look at the end of the trading day, that would be the MOVE index, which is kind of the sister index to the VIX index on stock volatility. I'm always looking at bond market volatility. As long as it stays within a very tight range, then the confidence in Federal Reserve policy remains intact. It gets published every day at 4:00.
Right. Okay. Now, you shared a few slides with me prior to. I'd love to jump into those. And it was interesting because you're watching a handful of things that are honestly off my radar. And so I'll pull up our first slide here. And if you could just provide an explanation about why this is significant. It's a century-long chart. My first question was, what do you pull from a century-long chart? But if you could walk my audience through that, that would be fantastic.
So the Quill Intelligence 2021 Outlook, the title of it was Starting Points Matter. And you're looking at the first chart that we showed, and it had to do with the fact that there was this conventional wisdom coming into 2021 that we were at the advent of a whole new bull market, that we were headed for vaccines in 2021, which is true, but that we were at the beginning of a new bull run in stocks. And a friend of mine sent this to me, and she said, what bull run starts at these levels? And if you look back to when stocks were the least expensive in data back to 1881, it happens to be December of 1920. So exactly 100 years ago, stocks were valued at the cheapest that we've known in modern times, and they were 7 times cheaper than where they were heading into 2021. And again, it makes no sense to me that this is the intersection where we're starting a whole new bull run based on really frothy valuations. And if you look at things like the level of insider selling,
yeah,
they're selling their stock at the briskest pace in more than a decade.
Right.
And mergers and acquisitions are going through the roof. So out the front door, they're using that stock price of theirs that has a very overvalued currency. At least that's how they view it personally, or they wouldn't be selling it out the back door.
Yeah.
So there are certain validating factors, if you will, that suggest that we're at anything but the advent of, say, a 10-year run in the stock market.
Okay. Now, I know a lot of people would agree with you on that. A lot of the guests that we have on the show are saying similar things. You know, they're seeing that their network starting to quietly de-risk from all sorts of things. Talk to me about what you're doing, Danielle. How are you, and what are you preparing for, and how are you preparing for it when you're looking at near term, like 2021?
So I'm not in the stock market right now.
At all. Okay.
At all. I'm not in the stock market right now at all. I am a seed investor. So it's not that I don't, it's not that I have zero risk appetite. I just prefer to be able to identify the risk on a very personal Warren Buffett kicking the tires type of way. And I can do that where I am. Yeah, I was just an innocent bystander. Yeah, my biggest call going into the year was silver. So
yeah.
just watching silver race all over the place these last few weeks, I'm just like, I'm just going to sit back, and this is going to go too far, and it's going to swing back. But as long as I'm in a better place than I was when the year began, then so be it. And that was really a technical based on the gold to silver ratio being so out of whack.
Okay.
Gold being so much higher than where silver was headed into the year, I said, this is going to correct one way or another. And it made sense to me because we know that Jay Powell's not even thinking about raising interest rates. You know, the idea of tapering Fed purchases, tapering quantitative easing was raised in his most recent public appearance. And he said it was inappropriate. It was premature to begin these kinds of discussions. So you know that the Fed is going to continue to try and debase the currency, which makes something like silver, which was a laggard, make a lot of sense. And then I haven't touched my municipal bond portfolio.
Okay.
Boy, has it. I mean, I'm starting to see bonds get called. So
Right.
Municipalities are smartly looking at their finances if they're calling bonds out of my portfolio, which I own on an individual basis. I would never own a bond fund.
Got it. Okay. Now, I mean, that silver call was right on. That was, I think, I saw that in the Double Line Capital Roundtable you're speaking at, and
Yes.
I mean, obviously that call is bang on, given everything that's happened in the last couple of weeks with it's called the Reddit short squeeze, et cetera. And I've had we just hosted a big event on this YouTube channel. I had about 50 personalities for one-on-one conversations, all talking about commodities. And, 2020 saw silver as the best performing commodity. The forecast across the board was for that to continue in 2021. How much of this recent 2-week, week Reddit short squeeze impacts that and derails that forecast? Or do you pay it? Does it matter to you, or where do you land on that?
I'm not paying too terribly much attention to it. It was funny because my Twitter feed got swarmed over the weekend with these crazy silver people. And I was saying, this trade might be going a little bit too far. And so they were attacking me and trolling me as being some kind of a pet of the Federal Reserve. And I'm like, oh my gosh, total strangers on my feed.
Right.
But we have to we have to bear in mind that the China slowing narrative really is in its infancy right now. There's not a broad recognition of the fact that China's economy itself is slowing with this second wave of the virus because they're not being very public about it.
Right.
But officials did allow PMI data, manufacturing and service sector data to come out much weaker than what was anticipated for the month of January. So the reason this pertains to silver is, I promise I have a point. We've seen a lot of supply chain disruption already. Silver is also an industrial metal. It's not just a precious metal.
Yeah.
So it has utility. So anything that benefits from further supply chain disruption than what we're already seeing. I mean, my gosh, Ford Motor has multiple plants shut down because it can't get enough chips in hand to build its vehicles.
Right.
So the more we see the supply chain disruption, which could worsen if China is going through a slow patch of its own, the higher the level of certainty that we're going to see an inflation scare. And if you're going to have an inflation scare, some of it's just mathematics, some of it's base effects, because we had such very low prints in February and March of 2020, because that's when the pandemic hit.
Right.
So everything just slammed into reverse. So even if you're just talking about not a quickening rate of inflation, but just building upon that year over year base effect, you could easily have an inflation scare that would put fundamental investors going into silver as well. So there's two different drivers, I think, of silver, because it does wear two separate hats.
I'm with you. Okay. Now, is that your main hedge against inflation? Is it silver? Do you look at gold as well? Or how are you?
Oh, I'm not touching my gold holdings. I mean, that's period.
What do you mean?
I'm not selling them. So I'm very happy with them.
Right.
So I do see them as a rational hedge. There are all kinds of hedges in this world, but what people don't realize is that a lot of times the hard assets that are referred to, real estate, I mean, it's just been on a tear.
Yeah.
You've seen home price, not commercial real estate, and certainly not urban center, but you have seen residential real estate just go on. And this is a global phenomenon right now, whether you're talking about Canada or Norway, any of those countries, Sweden or Australia. I mean, and the United States, 14, 15% year over year home price appreciation is not normal.
Right.
So the other traditional hard asset hedges aren't going to work as well, especially if you get an inflation scare.
Okay. Yeah, we're definitely experiencing that here. I live 45 minutes north of Vancouver, just outside of the city. Nice little mountain community. And we just got our assessment a couple of weeks ago, and I was shocked. Okay. Now, you touched on these different variants. I know you pay a lot of attention to the pandemic. Last time we spoke, your eyes were all over it. And you touched on, I guess, China's so far being not quite as transparent as they could be with their potential second outbreak. But we're seeing this all over the globe. It's not just China. And you shared another slide with me that is, I guess, the VIX index beginning to peak again. And I wondered how many factors, or what are the main factors driving that volatility index to start to climb? And do you expect that to continue? So if we are going to see a slowdown, or even in Europe, a double dip recession. Sure. You can't, I guess I'm too old. I've heard the decoupling argument so many times in my career. The United States is going to break itself free, and that it's going to be immune on an island to anything that goes on in the global economy. I don't buy that. We have seen somewhat of a reversal in globalization, but we're not there yet. We're not immune to what goes on in the rest of the world. Right. So, and you have to bear in mind that the Federal Reserve also, it really stopped the credit cycle in its feet with its massive liquidity injections. But you have to ask yourself, again, with valuations this high, is a Janet Yellen Treasury Department going to be near as sensitive to the stock market as a Steven Mnuchin Treasury Department? Right. I'm thinking no. And Powell's already said, hey, I'm going to let inflation run hot. I'm going to let it average above normal. Well, these are not friendly
developments for a credit market that's as massive as the United States is, and for other credit markets around the world that have seen massive corporate debt issuance. Whereas in other credit cycles, you might not have seen that same phenomena in emerging markets as you have seen in the past 10, 12 years or so. So the interest rate sensitivity is so acute right now. But again, I don't think that the reaction function is going to be identical to that of Steve Mnuchin. I think that Yellen will push harder for direct relief to individuals.
Okay.
And look for a way of not appearing to be bailing out Wall Street at every turn.
Right. Okay. Well, let's
feed through to your credit cycle. That's why you're starting to see credit volatility start to tick up.
Yes. Okay. That makes sense. Well, let's talk about that for a second. So stepping away from the market, looking at just the broad economy, I mean, like small to medium sized businesses. Have we really realized the full impacts of the pandemic yet? I think that I'm not sure. I feel like we're just beginning to see what could be the early stages of what you might call an insolvency crisis, right? The small to medium businesses, coast to coast, North and South, Canada, US, cross, but you can't print those small business cash flows. And this dance can only go on for so long. So do you think we're just beginning to see the true impact?
So I think that with small businesses, we have seen a lot of the damage that's going to be done. And, people say that I always travel with a dark cloud over my head. We have also seen a good number of businesses formed.
Yeah,
so we've seen quite a few business births.
That's right.
And, the people who were driven out of business effectively, they're still good business people. They still know how to be an entrepreneur. And there's a lot of push towards supporting small businesses right now.
Yeah, there is.
The credit cycle that remains to be completed is really in the middle on up to the largest, where they've seen lifelines extended to them because of the Federal Reserve's policy. They've been on the receiving end. There was $2.5–3 trillion of non-financial debt that was issued in 2020. We've never seen a year like that, but a lot of it went into companies that didn't deserve it,
right?
That weren't worthy. There's another slide that we've got. And it's one of my favorite. The credit analysts over at Morgan Stanley do a great job of trying to dispel the myth of the investment grade. I'm use air quotes here, the investment grade bond market, which, grandma and grandpa, it helps them sleep at night because these have, investment grade, the credit rating agencies are making sure that they're not going to lose any money on them. Well, if you look at the true fundamentals, and this is through the end of the third quarter of 2020, 58% of the investment grade universe should be rated junk, should be rated high yield, and yet it's not. It's over on that other side of the line again, because the Fed has been able to do so much to get capital into companies that aren't deserving of it. Right. So they're keeping these zombies, if you will, alive. But that is not good for the economy. It's not good for the prospects of productivity growth. And you have not seen the credit cycle fully go through a lot of these companies, like, for example, AMC Theaters, which was smart enough when it was the target of a bear raid, one of these massive Reddit raiders. Management was smart enough to go out there and sell stock.
Mm-hmm. Yeah.
Which, for the life of me, I can't figure out GameStop.
Right. Okay. So backing up though to, essentially what you call these zombie companies that are being floated, and how wrong or how bad this could be. Walk us through why. Like, how could that game end? Why is this such a dangerous scenario?
So the reason that we've had not one, but two slow recoveries in a row, and I'm not talking about 2021 when we could see 4, 5, 6% GDP growth, depending on how much stimulus is injected directly into the veins of people who are going to spend every last cent the minute they get it.
Right. That's
going to generate real economic output, real economic growth. But in the background, you've got 20% of large companies that are zombies that couldn't cover their interest expense if it wasn't for the fact, again, that the financial markets are being propped up by Federal Reserve monetary policy. So if you have this set of circumstances, you don't get new entrants. You might get entrants in the small business sector, right, but you don't get entrants, larger competitors, because there's no room. the capacity doesn't stand for it. So you're keeping companies that should go out of business alive, and you're not allowing companies to be born into this type of an environment. So the companies that remain alive, they're not job creators. They're just living on life support. And the companies that are being prevented from becoming new entrants, they are job creators. So that's why we saw throughout the housing bubble years in the United States such sclerotic growth, because the zombie population had built up. And then there were more zombies headed out of the great financial crisis. And so we had, the longest U.S. expansion in modern history, and yet it was so slow. And here we have even more zombies again today. So they're just a drag on growth.
And how can this resolve? Are these, is there potential consolidation activity? Some of these companies M&A targets for various reasons, or does this game just have to play out? Like, how does it end?
So you're right. Consolidation was another one of my big calls for the year. In fact, I think we're going to see consolidation in the financial sector as well. And you're seeing continued consolidation in the energy sector.
Yeah.
And that's fully rational, because many, many businesses in energy have filed Chapter 11, have restructured. So that portion of the credit cycle, that was allowed to run. So you have rational consolidation in a lot of these sectors. But whether or not you're going to get a takeout candidate that's a big zombie, it remains to be seen. Are Carnival and, gosh, I don't take cruises. There's another big cruise line out there somewhere.
Yeah.
Carnival's biggest competitor. Are those two, would it make any sense in the world for those two to merge? What would be gained from it? You double the fleet. And it's a very capital intensive type, and you're still in a world where you've scarred. Some people like me will never set foot on a cruise ship, but I was almost there beforehand.
Okay.
And we actually had our first cruise ever planned on Disney, and it was more money than I can even relay. It was so much money for 6 of us.
Right.
And the best thing that happened was when that canceled, I'm like, and I'll never go back. I think that there's going to be economic scarring in a lot of industries. You've got CEOs all over the world right now who are saying, my cost structure is drum tight. I have taken the benefits of no business travel straight to my bottom line. It's gone straight to my profit margins. So it's not that business travel is not going to come back, but it's never going to be back the way that it was before. If you're McKinsey or Bain or Deloitte, you don't have to put the consultant on an airplane in a business class at a business class fare and go park them at the Four Seasons or at the Ritz for a week at a time, and then they fly home on the weekends. They've already proven that they can continue to generate that revenue sitting in their homes. So the hotel sector is yet another area. Office property. There are going to be certain segments of the market that see, if not permanent, very long-lasting scarring.
Right. Okay. Now you touched on a couple of things during the conversation. 20% zombie companies. Tons of insider selling, and the VIX sort of beginning to hit new records, at least climbing anyways. So for 2021, where is the life raft? And you touched on gold, you touched on silver. Are you holding US dollars?
Well, I don't hold any other currency. So in that sense, yes. But to answer your question, when you see margin debt where it was, when you see hedge fund leverage as stretched as it was, very little cash on hand among institutional professional type of investors, you see those types of charts and you say, I know Ray Dalio said cash is trash, but boy, am I liking mine right now. So, and I do think that there's not enough risk reflected in the euro of this double dip recession. And the ECB is going to be just as aggressive as the Federal Reserve, the Bank of Japan. They're going to remain aggressive in this tacit currency war. So is it possible that because of the scale of fiscal stimulus being envisioned, that we can continue to see kind of this long-term downtrend in the dollar? It's quite possible. But you have to bear in mind that whatever we're doing, they're doing as well, but they haven't paid for it with their currencies yet.
Yes, right. And if we hit another crisis this year, like a market crisis, I mean, would you expect a similar flight to US dollars like we saw in March 2020? Is that still going to be the safe haven for the world if things begin to crumble?
Well, I think based purely on a technical read, which is the record position in investors who are short the dollar, you would see a boomerang effect just based on that alone. One of the most interesting aspects of the February-March meltdown in the stock market in the world was that you saw gold prices fall. Mm-hmm. And so professional investors were liquidating what they could to hold on to what they had. So again, for a technical reason, you could certainly anticipate, again, Jeremy Grantham is 84 years old. I'm not that old. I haven't been in the markets for that long. But when people like Jeremy Grantham come out and say, there's something really, really wrong with this picture, and he's called 2 major market tops. And so if there is disruption in the financial markets, I think the Fed will do what it can to back investors. But again, we're at such high valuation points. I go back to the starting points matter meme. Oh my gosh, I created a meme. I must be hip. But starting points do matter. Yeah. And we're starting from a very high valuation and very over indebted, highly leveraged backdrop. And you've seen so much of the rational, tangible growth that you're going to see because of this massive exodus to the suburbs and the exurbs. So in 2021, you're not going to get a whole bunch of people buying a house again for the first time. They own it. They're not going to buy a second one. They're not going to buy a second used car. They own it. My buddy David Rosenberg, he's a great example of, yes, services spending is going to come back when the world is vaccinated, but you're not going to get the same level of good spending that you've had for these last few months because people they've redone their gardens. They've built a deck. They've redecorated inside there. All of these things that you do because you're stuck in your house, it's not going to be repeated. So you can't place so much stock in this, boy, people are going to spend coming out of the vaccine. They're going to travel. If they're wealthy, they're going to travel more, but not if their stock prices have gone down. So there's so much tension right now.
Right. Okay. Look, I appreciate your time, Danielle. It's been great reconnecting with you. And just to recap, we're 0% in the market right now. You're holding your gold. You like silver and specific municipal bonds. Thanks so much for coming back on. It was great to reconnect and appreciate your time.
Thank you very much. Thanks for having me again.
Thank you for tuning in today. I hope you enjoyed it. I hope you learned something. I certainly enjoy producing these events. Please hit subscribe, stay up to date with what we're doing. We're putting out fresh content several times per week, and we love doing it. Thanks again.